What's going on, everybody? Today, I'm going to make a video over my trading models. I posted this on Twitter before, but nothing with actual order flow in the feed from, TradingView or wherever you get it from. So I wanted to make it pretty simple, straightforward as possible. There's some things I'm going to talk about on the next slide that are reminders, things to kind of jot down, because there's a lot of things that go into making a model, and that includes your personality. That includes the things that you tend to lean towards. And I think that's important to note because we're all individually unique. And just because I say something or somebody else says something doesn't mean you have to directly mold yourself into that. So I'm going to do a PowerPoint slide, just a few slides, and then I'll go over to TradingView and actually show a couple charts just so you have a visual representation of what it looks like. So let's go over to the first slide here. This is the reminders. This is really what I think is the most important, and it may bore some of you, but it's very, very important. So the first note is each model is a skeleton, and you will uniquely mold into it. So what that really means is you're going to be given a framework, and ICT is given this, and one of the models is from the 2022 model. And many people have asked me if I use it, if it's something that's, worthy to study, and of course it is. But your own personality is going to put in different characteristics and models into that. So it's just a skeleton. It's something that you're looking at in the background of what's really going on. The models will not look exactly the same every time. And when I first began studying these concepts or just trading in general, I thought every single time it had to look exactly the same or else it wouldn't work. The market is not going to print the exact same order flow, pip by pip or point by point every single time. So you have to understand that, again, you're looking at the skeleton. You're looking at what is the pattern I'm looking at, not necessarily the candlesticks, if that makes sense. So the models will form on every time frame, but it's up to you to select the time frame. So if you're a swing trader, intraday trader, somebody who likes to hold, then you would be looking at a higher time frame perspective. You'd be looking at a daily chart, a 4-hour chart, maybe even a 1-hour chart, and you'd be looking for those to form on those time frames in order for you to enter. If you're a scalper, somebody who likes lower time frames, then you're going to be on the 5-minute, 1 minute, because those are where they're going to repeat a lot. Now, again, this is where models get confusing because each model, depending on what time frame you're looking at, is going to be unique to that time frame, to the liquidity, everything that is surrounding that time frame. You have to understand what's your risk on that time frame, what's realistic to target for profits. All of those are unique. So you have to take in consideration when you're using a model, what is your personality? What do you tend to lean towards? What is the repeating patterns that you specifically do over time? Each time frame will form unique characteristics. So it's the same thing that I'll put in the next slide is inside of each of these models, there's going to be things that uniquely surround it at that particular moment in time. So sometimes there's going to be more confluences versus some models won't have as much confluences. So for example, you're going to have in one model, maybe you'll have a new week opening gap in confluence or a new day opening gap. You might have the RTH gap, in confluence with it to target it, to utilize it. You might have a clean market maker buyer sell model that's really visible to you that you can utilize. You might have a higher time frame PD array that's playing off of that model in that exact spot if you're on the lower time frames. So overall, the main thing that you need to look at, and I've always shouted this, is looking at the narrative and the higher time frame perspective, because these are going to increase the probabilities of these models actually working in your favor. Because if you look at the times that you get models wrong, A, you probably read the market wrong, or B, you read the overall narrative wrong. And what is narrative? Narrative is the underlying tone that's happening from a higher time frame. So the monthly, the weekly, the daily, all of those are parent time frames to lower time frames. Everything else will submit to it. So if you're in a bullish environment on the higher time frame, then you can't be looking for short models because they're less probable to play out. You need to be identifying what the higher time frame narrative is and then aligning these models to that narrative. And that's going to increase your probabilities of these actually being profitable. So the first slide is going to be model number 1, which is external rate, which is literally the 2022 model from ICT's YouTube. Believe it or not, this is part of my model because it's so simple and easy. So if you've already gone over this, it's extremely easy to utilize. And if you've got it wrong, you don't see it working for you, most likely, if you go back to reminders, it's going to be the narrative issue because you're not looking at what is happening on the higher time frames. You need to understand that. So I'll go over the rules and the criteria really quickly. You're looking for buy side or sell side liquidity ran, right? This little skeleton here can look in so many different formations. So don't pay attention to so much of what this, it has to look exactly like this because that is a skewed view to look at a model. What you're looking at is the repeating phenomenon behind this little pattern. And what is that? Well, it's sell side being ran, it's a shift in market structure, and then a fair value gap inside of a discount or premium to target buy side liquidity. And if you flip it on the sell side, it's going to be the exact same thing, right? So in here, I also have multiplier. If you don't like fair value gaps, this is where you customize it. You're using what you like personally. If you like order blocks, you'll enter off an order block, mitigation block, breaker block, whatever it is, volume imbalance, whatever it is, you customize it and you put that into your model and your criteria. My advice is to use one multiplier, meaning you only enter off of only a fair value gap or the ones that I just listed. Because if you start to utilize every single PD array, that's where things can get confusing. You can't track your progress as much. And that's what happened to me because I was trying to use every single PD array. I was trying to use everything at once. I only enter off of fair value gaps. Even though I know all of these different PD arrays, I just utilize them in a different way. I don't utilize them to enter into the market. I utilize them to read the market. And when my fair value gap forms, that's when I enter into the market. I'm not saying it's the best. It just works for me, right? It's all about you. It's all uniquely on you and what you want to do with your model. So if you look at the bottom, it says extras, quotation seasonings. I think of a model very much like any recipe, a soup, whatever that may be. You have your base lining of it, and then you add in the seasonings to make that recipe better. And for me, I have a list of things, and there's plenty more that I could have put on here, but it's just a list of things that can make the model better, supercharge it in a sense. But the main thing is to always look at the skeleton. So I've already talked about this, but the seasonings could be, there could be a new week opening gap or a new day opening gap in Confluence, the RTH gap, market maker buy or sell model. It could be inside of the silver bullet window. It could be a macro. It could be off of a higher time frame PD array. It could be one trading session for one trading setup for life, which is you're targeting previous session highs and lows. Maybe it was a raid on previous session highs and lows. So these things all supercharge the skeleton. You just have to find what works for you. And maybe there's only one of these in confluence with your skeleton at that moment in time. Remember, each model is going to uniquely form. It's never going to have all of these in confluence. So you have to just pick and choose and see what works for you. And that's really my best advice because in the end, if you try to throw everything at once, or if you try to wait for perfection, if you try to wait for too many confluences, you're going to miss out on moves, and that's money left on the table. So let's go over to model number 2, which is an internal raid. It's much like the 2022 model, but it's inside of a higher time frame dealing range. So if you look at your dealing range, which would be this low down here and that high there. So let's say this is a 5-minute parent dealing range. Typically, this is what I'm looking at, where you have a 5-minute dealing range, and then when I'm looking inside of that fractal, I can see in a 1-minute time frame that we dip down into a discount, right? The discount parent dealing range. And then on the 1-minute time frame, you're having an internal raid on sell side liquidity. Then we're having a shift in market structure above an old high, and then return back down into a fair value gap. Now, sometimes this might go into a discount. It may not. It may just use IOFED, which is institutional order flow entry drill, which is another part that I should have put inside of the seasonings. You can use IOFED a part of the seasonings. Sometimes you don't reach into discounts or premiums, and that's due to certain characteristics that are surrounding that model at that particular moment in time. And here, I already went over it. Again, the multiplier. You could have seen this as a breaker, low, high, lower low, then higher high, entering off of a breaker instead of the fair value gap. Whatever you like best, right? And then you're targeting the buy side liquidity. Model number 3 is the easiest model that I've personally have observed and used. I love this model. It's a continuation model. Now, with this one, you can have a bunch of different characteristics and things that surround this. For an example, sometimes when I like to use this model is if there's already a higher time frame buy side or sell side liquidity raid above or beneath the old low or high, and then price energetically displaces higher, and then you just have an open fair value gap, you have a shift above the old high here, and price is just reaching down into a discount to expand higher again. You don't need anything inside of it. You don't need an internal raid. You don't need, sometimes you may not even have an old sell side or buy side raid. This is used when you're targeting an old high, which is a really strong draw on liquidity or low. And it's just energetic. It's fast. You can see that price is not going to take out any lows or highs. It's just going to simply reach for an old liquidity pool. Again, in here, you can add any seasonings, whatever you'd like inside of it. So I think it's pretty straightforward. It's easy, but the main takeaway, I know it sounds like a broken record, you are unique, and each model is going to be unique when it forms. So you have to adjust yourself to it. Let's look at some actually real-time charts here. So this is model number 1, 2022 model. And here, you can see we have, this is actually supposed to be buy side. So this is buy side liquidity ran, right? We reached above an old high, and then we see a displacement lower shifting underneath an old low. So we have number 1, buy side liquidity ran. What's number 2? A shift in market structure. What are we looking for on number 3? A retracement back into a discount or premium. So if we looked at our dealing range from that high down to this new low that's formed, we're looking for anything that reaches into equilibrium or higher. So we could be looking for optimal trade entry, or where is equilibrium, which right above that is premium. What's resting right inside of that area? A fair value gap or a multiplier. So you could have looked at the fair value gap to form. You could have looked at an inversion fair value gap. You could have looked at these last 2 up close candles as your bearish order block. So do you see how whatever jumps out to you the most is what you're going to utilize? Number 5, you're targeting opposing liquidity pool. So what would be an opposing liquidity pool? Well, it'd be first the dealing range low. So anytime you're utilizing these models, you're looking for the opposing dealing range low or high as at least the first objective. So in here, we'd be looking at that low there. And then what's underneath that? This old low here. So we have sell side liquidity resting underneath that low. So we'd be looking to target that. Now, this is actually I'm still going to show a model number 3, but this is model number 3 in a sense, where we've already had a buy side liquidity ran here. We had an energetic displace lower, another shift in market structure underneath that low there. Now we have a fair value gap formed, and what's our dealing range? From that high down to this low, equilibrium's here, and we have a fair value gap. So we're looking for price to reach up into there. We could utilize optimal trade entry, which is negative 62 and 71. Fair value gap here, and we enter into the market. Our stop loss would go above this high there, and we'd be looking to target the dealing range low, and then we also had sell side liquidity resting underneath this low here. So do you see how sometimes you're going to have for me, a model number 1, and then we jump into model number 3. So if I miss this move, then I could look for my third model here. Even in here, this is still a model number 3, but this is unique because we're not reaching up into a premium necessarily. If I would jump down to a lower time frame, I may be able to look at a lower time frame dealing range, but this is just simply an IOFED into a fair value gap. And if you look to the left of you, there would be a mitigation block. So in here, our last down close candle, it's a mitigation block, not a breaker. That's in confluence. So each setup's going to have different things that are in confluence, and you can utilize in that moment of time. You just have to be able to identify that. Even going back up to here is, well, if you didn't like the fair value gap, you could have utilized the inversion fair value gap here. You could utilize the bearish order block, which are all these up close candles there. You could have utilized the mitigation block here. Whatever jumps out to you the most. If you're able to identify all of these, that's great because you're able to obviously see a lot more confluences in real time. But my advice is to stick with one PD array, look for that to form. If you can utilize other PD arrays in confluence, then so be it, and it makes your case a lot better, right? Let's jump over to model number 2, which is an internal grade. So in here, you could see dealing range low and dealing range high. So this is our parent dealing range. Everything that's going on inside of it, that is internal. So we have a retracement on our parent dealing range back down into a discount, which is optimal trade entry. And here on the 1 minute time frame, you can see how price is displacing beneath internal sell side liquidity and rejecting off of a bullish order block. So we have step 1, identify parent dealing range, which is here. Step 2 would be internal raid on buy side or sell side liquidity. So we have internal, right? This is internal sell side liquidity being ran. Step 3 would be shift in market structure. So in here, this is an old high. We're shifting above it. That's an energetic displacement higher. Step 4 would be a fair value gap or a multiplier formed. What is this? A fair value gap. So that's formed in here. You could utilize these last 2 down close candles, which would have been your bullish order block. What are we doing? Targeting opposing liquidity pool, which would be the relative equal highs there, and then the parent dealing range high here. And if you wanted to hold on longer, you could have looked for negative 0.5 standard deviations of the parent dealing range. Again, if you wanted to add all your other seasonings, that's where you start to, put it into the model. Let's look at model number 3. I've already covered it, but this is another example of it. So in here, you can see there's a strong energetic displacement higher. We come back down into a fair value gap here, displaced higher again. So there's no need for sell side liquidity to be ran. We've had an energetic displacement higher. We're reaching for some type of higher time frame PD array or buy side liquidity pool, right? We shift above this high and we're dropping back down into, this would be our dealing range low from here to our dealing range high. we're dropping down into a discount. So you could have utilized the fair value gap to enter, or you could have utilized the order block. But the main thing is you're looking for, we have a shift in market structure. It's energetic. It wants to get somewhere fast. So all we're looking for is, can we just look for a discount to be reached with a multiplier, and then can it reach higher for the dealing range high or another opposing liquidity pool? So in here, we reach down into the bullish order block, displaced higher, reach down into another bullish order block, displaced higher, IOFED the fair value gap, and then it was off to the races. So as you progress within these concepts and within your model, you're going to be able to customize it, and you're going to be able to enter at different areas and different spots of your model. For an example, if you weren't able to get into a position down here, but you saw price displace higher, you see a bullish order block, and you're able to enter in here, what would be the logic? Well, we've already made a low in here. It wants to get somewhere. So if it is bullish, it's going to respect all bullish PD arrays. Dips down into here, displaces higher, leaves a fair value gap. If we weren't able to get into this position, well, if I can get into this one, I can look for this old high and possibly a little bit more. Looking for an IOFED in here, enter it on the market, and displaces higher. So as you progress, like I mentioned, it's up to you to utilize the model uniquely. And it's all going to take time. This is not something that's going to happen overnight. Even back testing is not going to do you as much service. I think forward testing is the best option for you. Doesn't mean you have to use live funds, but looking at price in real time and being able to track what you were thinking in that moment of time and what you were doing, what your actions were like, are very, very crucial, because hindsight like this is very easy, and it can trick you into making you think that trading is so easy and that these models are, super easy to utilize. But it's not the case. If you've been around long enough, you understand what that means. I don't want to put a damper on these models or on the video, but in general, you need a lot of time and a lot of chart experience to decipher when a model is high probability, what that model really is, the things that are surrounding it, etc. So I think that's going to be it for this video. If you guys enjoyed, please drop a like and a comment. If you want to follow me on Twitter, it's _CJ Trades. And until next time, good luck and good trading, everybody. Be safe.